Thank you, Carl, Leslie, and Mike. Welcome to the Halftime Report. I am Frank Holland in for the Judge Scott Wapner. Front and center at this hour, playing the pop, stocks hitting session highs as the tech sector tries to avoid its worst week since April. Our investment committee standing by to break down the move and much, much more. Joining me for the hour, we have Josh Brown, Steve Weiss, Kevin Simpson, and Rob Sechan. But first, quick check of the markets right now. As I mentioned, we're at session highs right now. The Dow's up just about 630 points. The S&P above 1%. The Nasdaq right around 1% higher. So the Russell, the small caps, up over 2.5% right now, making the biggest move to the upside. And with that, Steve Weiss, you're right here to my left. I'm going to turn to you. It seems like the Williams comments were the start of all this, and the market just kind of ran with it. So is this the answer to the question we're always talking about, whether it's earnings or the Fed that's the driver for the market?
Well, it depends on timing. When you're right in front of earnings, going through earnings, then it is earnings. When you're right in front of the Fed, and we'll get the Fed decision in a couple of weeks, then it's the Fed. So, look, I've been pretty consistent in my view that we're going to have volatility, that I don't expect to see the January effect, which happens earlier and earlier each year, until we get through NVIDIA and then we get through the Fed. Now, yesterday was stark, the turnaround. Only 3 times the market opened 100 points since the 1950s and then finished in the red. Each of the 3 subsequent periods, those 3 times, you've seen major moves in the industry higher. However, I don't know if there was a Fed move in the offing. So right now, the majority of those that are polled believe, and the odds that we see in the various prediction services are positive towards a cut, but I don't think it's a done deal. And I do believe, despite everybody saying that, it doesn't really matter, it does matter, as we saw it yesterday, as we saw it today. So the bottom line is that the market should be okay right now, today, hopefully, and obviously can be proven wrong, but I really don't see major upside until next year or the end of December. Now, that's because I just don't see investors continuing to catch a falling knife in big cap tech. And despite the decline in big cap tech, and others have tried to go in, right now, some could say they're overvalued. I think it's a case-by-case basis, and it's not. So I've been staying in positions in those and just putting on the shorts and the Qs, but still have more exposure than I would have liked to over the last month.
All right. You mentioned yesterday's action. Josh, I'm going to come over to you. Obviously, we saw a big reversal in the markets following NVIDIA earnings. Today, we're higher after those comments from Williams. Does the action yesterday, does it matter for today? Does it matter going forward for the rest of this year?
Look, I think it's really healthy in a bull market to have these moments of extreme doubt and uncertainty. I think it's great. You get a VIX spike to 25. It shakes people out of some trades that maybe they didn't belong in to begin with, or they were too heavy. It makes people second guess some of the more speculative things that they've been doing. And if you want this bull run to continue, you want those moments to happen every once in a while, because it stops us from building these types of parabolic charts and outrageous expectations for returns that put people in a really bad position for the eventual corrections. We really haven't had a meaningful correction since April, but we have had these moments like yesterday. We had one in the middle of October, some people probably remember. And overall, I really just don't view it as the end of the world. I agree with almost everything that Steve just said. But I have a slightly different point of view on the mega caps. I think they are going to lead us into year end if we get that sort of like melt up environment, which we've seen in recent years. And I think these are the stocks that are going to be at the forefront once again. And I know a lot of people want to change a narrative, and they want to believe like the energy, healthcare component of the market has legs, and that could lead us for another few months. I'm just thinking about like the discounts in these shares right now relative to where they were just recently. And I think if people are bullish, that's where they're going to go. Like I'm looking at Meta in a 26% drawdown. I know they're going to buy it. I'm looking at Tesla in a 19% drawdown. You know they're going to do it. It's going to aggravate everybody, but they're going to do it anyway. NVIDIA in a 16%, Amazon, Microsoft both 15% off their highs. I can't escape the feeling that it'll be second verse, same as the first, and they're going to go right back to those names. You have the most liquidity, you have the most familiarity, and you have people that, for whatever reason, maybe they weren't in some of those on the way up in the first half of the year, and they're just going to go to what they know. And so I'm a little bit more constructive in that part of the market than maybe Weiss is, but I agree with the rest of what he said.
Yeah, I am constructing that part of the market. I haven't sold anything, as I said. It's just a time where I think you and I may differ. But I'd love to see what you say to come to fruition.
All right, Siege, go ahead, jump in.
Yeah, I mean, I think we all have to appreciate how frothy the markets got in September and October. And we may have pulled forward the Santa Claus rally, made it a little earlier. And you obviously had some liquidity scares. You had some deleveraging scares. And there was this Molotov cocktail that was thrown at the market. And yet we're still only off 5% from the highs. And really where we saw the biggest shakeout is in some of the more speculative names. And, you know, from my lens, that's a healthy thing. The key is making sure you're in a position and you have a healthy athletic stance with enough cash to meet liquidity needs, buy into weakness, and not be over-levered. And it's clear that margin balances had built a lot, and so there was embedded speculation in this market. I do think you could see volatility continue a little bit. There was a life preserver thrown this morning by Williams, no question, with a with a kind of dovish stance.
I think it was a whole rowboat.
It was a whole rowboat. But you have to look at this as a valuation and positioning recalibration, which is almost necessary, which makes us think that this is going to be a shallower correction versus the deeper ones that you would typically get with a growth scare that would come from EPS cuts or cuts to GDP next year. I don't think you're going to see that just yet. Again, you might have to have some more deleveraging here in the very short run, but I think a little more intermediate term, you're going to focus on those things. One more thing that I'd say, it's not like we're off to the races again, though, because we still have some pretty huge embedded earnings expectations in the markets for 26 and some pretty ambitious targets, right? Okay. So that valuation's high.
Second, but very quickly, you just agree with Josh when you said tech's going to carry us the rest of the way. So if it's not off to the races, how does tech do that?
Well, no, I think the companies, you have a bifurcation within tech. You got to look at it as K-shaped. You have the haves and have-nots. Look at the valuations on some of these names. They've come in quite dramatically,
you got
right?
Some reporting next week. Which one of those would you say are on the bottom of the K or the top of the K?
So, listen, I think the best positioned companies in the Mag 7 are the ones that we are most overweight. It's Google, it's Microsoft, it's Meta. Google is our largest overweight by far, followed by Meta second. There's some digestion issues in Meta. They have to prove that their spending's making sense from an AI standpoint, that they're able to monetize the AI. But when you have the eyeballs they have, once they get focused on it, I think they're going to be huge beneficiaries.
All right. Kev, I want to come over to you. You and I, we were having a conversation before the show, if you don't mind me kind of bringing it into the show, about whether there really is a correlation between crypto and mega cap tech. Today, we're not necessarily seeing it as much. Crypto's down, and we're starting to see the market kind of recover.
Turning.
But it is being led by healthcare, in all fairness. Healthcare is the leading sector, hit a record high. Is that something to worry about for an investor for the rest of the year, especially going into a low volume week next week, a holiday week? The idea that crypto and crypto margin buying can be the cause for equity selling?
I mean, it is. There's little doubt after this week. And playing off your deleveraging comment, the one thing we learned with certainty is that Bitcoin 100% is not a correlated asset. For years and years and years, we were told there's correlation, that there's non-correlation. This is a correlated asset. This is something where we're seeing so much intertwined trades on the more speculative side of things that when you watch it unwind today, it's not just the crypto trades, not just today, this past week, really since the election, all of these small companies, all of these more speculative trades, we're seeing them down 20, 30, 40%. So that's the lesson that we learned today. This is a correlated asset, and that debate is
just a liquidity-based asset.
You can still make money with it. I'm not saying it's a bad investment.
No question.
But then how do you trade until it hits a bottom? Because I think I've heard a lot of people in our area saying that the level of support was supposed to be around 87. I've heard other numbers.
Supposed to be 100. It's supposed to be 90.
Exactly.
No, but if you do look at the technicals, there's obviously different support levels, whether it be talking about the stock market or talking about the crypto market. You're looking at moving averages. Josh, Cameron Dawson from my firm, Tom DeMark, they are all looking at these levels. And I'm telling you that right now, a lot of those levels, provided you've gotten through the deleveraging, are flashing green. Doesn't mean you can't overextend and test the next level, but it all depends on how much damage structurally was done from a leverage standpoint.
You know, the issue with Bitcoin, the reason why I trade the momentum from my standpoint is that you don't try to pick the bottom on Bitcoin. It's even more of a fool's errand to pick the bottom on Bitcoin where there is no, tangible value. When I look at what support is on, say, an equity, I've got two areas of support. There's the technical support, and I'm not a big technical trader, but there's the valuation support, and that's like an EBITDA level, it could be a PE level, it could be a price to revenue. There is none of that here because there's no use case. There's no use case.
Guys, I don't want to interrupt this conversation.
That part's true.
One quick note. Right now, the Dow's hit session highs, jumped about 700 points. I'm looking at the S&P and the NASDAQ. Both of them are higher, above 1%. The S&P up about 1.33%. Don't mean to interrupt, but Josh, I want to come back over to you. How should we view this right now? We're going into next week. It was a holiday week. It's about 3.5 days of trading. How do you view this very small move to the upside compared to the week-to-date action and going into the weekend? I mean, give me your take on it.
I just think today you're undoing some of the damage from yesterday. And the most important thing, which we have pointed out a lot over the last 10 years, and it's only become more true, it's a really big mistake to look at the tape on a day like yesterday and think that what you're watching is human beings making a conscious decision that they no longer like Amazon. Or it's Jane Street. You understand? It's Citadel. It's Susquehanna. These are quantitative trading firms that are responding to and reacting to signals that the human mind cannot possibly comprehend because they were created by computers and AI. There's not always a narrative that perfectly fits with, and today is the reverse of that. So today, does everyone's opinion change 180 degrees from yesterday? Absolutely not. There are machines trading against other machines that are themselves programmed by a third type of machine. Stop trying to take your market narrative and write it in pencil, not pen. Free advice. Free advice.
He's totally right, though. The machines can pick up on the syntactic intent that Williams had this morning and totally pivot it like that and trade way faster than you or I could ever think about doing it.
So it's like a Tropic Thunder moment. Is the dude who looks like the other dude who looks like the other dude type of thing. So really quick, ahead of this mini rally we're seeing in Williams, Wells Fargo came out with this 2026 outlook. A lot of hope in the first half. They say bubble in the second half. They put out their year-end price target for 26. It's 7,800, about 15% higher than we are today. They say they're going to be overweight tech, energy, financials, and materials. They say AI will ultimately lead the market higher in the second half, kind of playing off the theme you guys are talking about. And also Fed balance sheet expansion starting in April could drive the sharpest rebound in liquidity conditions. Weiss, I'm going to come back over to you. Is that the issue here? We need a little bit more liquidity?
Well, Josh pointed out about the algos. It's believed that they're more than 50% of trading. And then when you take a look at what index funds own, that's also about 50% of, they're not to be added, of course, 50% of every public equity. So there is somewhat of a lack of liquidity in the market under conventional standards, but there's still more than enough liquidity in the market for any outcome. And it really depends on the underlying equity where the liquidity is. In the big cap stocks, there's no shortage of liquidity on any day there is, and that's really what we're talking about. So to me, I agree again with Josh. That's where the money's going to go because of the fortress balance sheets, the gross aspects, and eventually, I think investors are going to realize that while they all have massive capex that they've talked about, up to $100 billion, they're not going to be able to deploy all that. because you're not going to have the energy, you're not going to have the skilled labor, the electricians, et cetera, that are able to build out the data centers, but primarily it's energy. So to me, it's going to be like a massive stock buyback gets announced and never gets filled, and then they announce another buyback and incorporate the prior buyback into that. So once that reality hits, I think we'll be fine.
So does that mean you should buy energy right now? I mean, the idea that energy prices have to go up if there's going to be a squeeze, right?
No, because it's electricity. Because it's electricity.
Yeah.
Well, I think it's going to be everything. It's going to be nuclear. It's going to be natural gas.
To build on that point, though,
they're building.
To build on that point that Steve is making, there are physical constraints in the physical world that will make it so that every one of these capex announcements isn't as good as signing a contract and sending an ACH wire. GE Vernova is telling the street that they are now fully booked up through 2028. So if you come to them with a project today, that's where that project is going. Think about how long from now 2028 is. We'll have a new president, maybe, in the White House. So this idea that like somebody could tweet something about the capex of their company and just will it into existence, you need transformers to be built. These are house-sized assets that convert energy into electricity. Like it's a very long game. It's not as simple as, hey, we're going to do this and then it just gets done. And what that means is it's like a backlog of earnings beats far out into the future, provided it continues. Because you don't know when these things hit, when the money gets spent. We're dealing with atoms in the physical world. It's not Twitter.
All right, that's a fair point.
The other point is that we're involved in a company that makes linear generators, and that company's been around for less than a decade. But you have no idea for all these technologies, including small nuclear reactors, what it takes to build them at scale. It's phenomenally tough with any CapEx technology, hard technology, post software. So that's where it's going to fall down. Then finally, I think it's critically important. Do you really think that politicians are going to not push back on data centers in their backyard when they've got all their constituents saying, I'm not supporting this through higher electrical prices, particularly when I've been under pressure from inflation going forward. So we're seeing that play out.
All right. I mean, that is an interesting point. The energy constraints are obviously a very important point. Where's it all going to come from? And then there is some questions about regulatory, especially when it comes to nuclear. We talked about Constellation Energy this week and that $1 billion loan from the administration. But you're right. There's going to be some people concerned about what used to be 3 Mile Island starting back up. And I mean, maybe rightfully so. I mean, after the catastrophe that happened there. By the way, we're about 17 minutes in the show. We're going to talk about NVIDIA right now. It might be a bull market record. We wait 17 minutes to get into it. Everybody owns it. Kevin, I'm going to come over to you. NVIDIA still lower right now. It's down about 1/3%, 0.5% right now, but the markets are higher. Also, we saw a great earnings report, and the markets moved lower. What does that say about NVIDIA? Is it time to change the way we look at it as a potential market mover on earnings or a bellwether of where the market's going directionally?
How sad is that when you have earnings that were that positive across the board and when the guidance was so good that the stock sells off? You and I were talking in the morning when the stock was up, and here it is down again for a second day in a row. I would look at this as opportunities to add to it. I think Josh nailed it this morning at the open with respect to all of these companies that are down. They're going to attract money. Maybe there's tax selling. Maybe there's reasons people need to take profits here. You know you've got wins in NVIDIA. And so to the extent that you're going to take profits there and offset it, kind of makes sense. But from a fundamental and a foundation standpoint, is this the bellwether that'll lead the market higher? Probably will continue to do so until it proves otherwise.
Seach, you feeling bullish on this one? I mean, Wells Fargo came out, maintained an overweight rating, price target 265. I mean, looking at where the stock's trading right now, it's trading under 180 right now.
And at a 26 times forward PE, and it rarely gets down to these levels from a valuation perspective. We've added it 2 times. We could never own this company for so long because it didn't meet our valuation relative to growth screens. We've bought it several times. We're still slightly underweight NVIDIA, but have a very big position. If you look at what the opportunity is in this company, I suspect they're going to continue to deliver on expectations for a very long long time. I think what was interesting is markets were very much pivoting because of the backdrop, not so much as it related to earnings and what NVIDIA did, but when you get from companies that are delivering good earnings and starting to sell off, it is changing the narrative in the market. Hopefully that's not too long that happens, but you could see there was this desire to deleverage. You had Tom Lee on the show, I think, Frank, and he was talking about what was going on in crypto and the deleveraging there that kind of created an interesting lead for some of these other tech companies, these risk-on companies to follow. I think these are different worlds. I also think there's been too many parallels, and you saw it in these earnings, of NVIDIA to Cisco in the late 90s, where they were taking pieces of some of their customers.
Vendor financing.
Yeah, vendor financing. You know what? This is an important business for them to get this data infrastructure built out. I feel like we are in a very different environment relative to late 99. Sure, there's things that rhyme all the time. However, these companies that are driving this are very profitable, very solid balance sheets, and I think are going to be well supported.
Kevin, I'm going to come back to you in a second to talk about some of the other things that are going on that are kind of reminiscent not only of the .com, but also of the great financial crisis. But before we do that, Josh, coming over to you, looking at NVIDIA. Week to date, down 5% again after those fantastic earnings. Is this a viable dip, or do you need to wait?
I mean, I can't buy it. My average cost is single digits, and I've held it forever. But like, if I were not invested in the stock and I had no position, and I was like wondering, how did I miss out? What do I do? Blah blah blah. I'd pull the trigger at 180. I think the stock gets back over 200. We already saw a sneak preview of that a few weeks back. Nothing in that earnings report or in the guidance tell me that things are not even better than they were the last time it was above 200. And from my perspective, I think it's inevitable. So I would not be afraid to buy it here.
And we are back on halftime with some committee moves. Bill Baruch is with us. Bill, going over to you. You just exited your Tesla position. Walk us through that and why.
Yeah, this was a name we bought back in July of last year. We're up 100% on it. And as an active manager and as a risk manager, I couldn't walk away from yesterday without doing. It had broken down on November 12th out of a consolidation range. And yesterday's early action was a retest of the 50-day moving average out there from yesterday, as well as the indices with huge tails overhead. And this does worry me. I want to do something and get ahead of it. But not only that, there is a little bit of a shift in risk sentiment. So, you know, if we're going to start to see any type of move lower, I want to have more flexibility. So we exited our main portfolio and this gets us in our main portfolio back to about 4% cash. And as the week evolves into next week, and see how we close here today, but forward, Tesla is a name that you want to look to be trading more, and getting back above 400, I think, was a great thing. But I don't want to see the same pattern develop that we saw last year and this thing fall out. So I'm getting ahead of it and getting more flexibility in the weeks to come.
All right, Bill Baruch exiting his Tesla position right now. Tesla about 1.25%. Bill, great to see you. You might have been using that Starlink internet. I think the team over there was like, stop talking about this. We got to get out of here. Kevin, coming over to you. You own Tesla as well. Kind of interesting time to get out of Tesla as we see Elon Musk and the president apparently making up. It seems like they're making up.
Yeah, but who knows how long that'll last, Frank. I agree with Bill's thought process. This is more of a trade. If you're an investor in Tesla, you're going to be for a very long time because you're not owning it, as we've talked about a million times, as a car company. This is robotics. This is energy storage, self-driving cars. That's the reason we own it in our growth portfolio. We don't look at the day-to-day action. We write calls against it consistently, and we'll hope that 10 years from now, everything that was dreamed up comes to fruition.
All right. So you agree with the trade. You want to get out here, even with the idea of the robotaxi launch and everything else, because it seems like this company has a lot of upside going into 2026.
Oh, I don't know about the short term. If he's a trader and he wants to free up some cash and he's doubled his money on a position, from that standpoint, Frank, it doesn't matter what the ticker is. You're just thinking risk management.
That's fair. Any of you guys have any thoughts about getting out of Tesla right here? Again, it seems like, at least in the near term, Elon Musk is being a bit more friendly with the administration. Robotaxis rolling out, made a lot of announcements about humanoid robots ending poverty, making it so none of us have to work anymore.
No money.
They have
Yeah.
potentially no money.
You know, the interesting thing on humanoids or robots is that it's already a crowded field. So it's going to take a long time to really put them into the household, but it's crowded. I mean, you've got Figure, which without a product, a real commercial product, just raised capital at $38 billion valuation. And then robo-taxis, of course, we know how crowded that is, and we don't even know what the economics of it are going to be. They will not be the same positive economics that you see with Uber, because there the driver absorbs all the real costs. On robo-taxis, and I know that they've worked out some planning for this, it's the Waymos of the world, it's the Teslas of the world that are going to assume those costs of maintenance, of insurance, of fuel, etc. So it remains to be seen. Right now, he's marketing it great. He always does. And I guess you got to bet on Elon, even though I choose not to.
Josh, any thoughts about this trade, Tesla, the competition for driverless vehicles? I know you're a big Uber guy. Another company in that race as well?
I have nothing further to add on the subject of Tesla. I am long Uber. I don't really view them as being in competition right at the moment. Tesla's automated taxi service still has, for the most part, human beings driving them. And I have no idea how many they have to have out on the streets to actually do that profitably. Uber is an asset-light company, does not own the cars, does not maintain them, does not have to fix them or service them, and it's an entirely different situation, and I just don't view the two as being in any way comparable.
All right, fair enough.
Josh, should we be adding to Uber here? I'm sitting with it too.
I mean, I refuse to sell. I understand why it's fallen. It's as cheap as it's been all year long. You're talking about like a 22 multiple. Every time they report, they're making more and more progress on the automated front in terms of partnerships and initiatives. And ultimately, in the future, all of these automated cars, for the most part, will be owned by private equity firms. They'll be like an asset, like a yield asset. I don't view that as being where the value will accrue. I think the value of having millions of automated taxis on the road will accrue to the software layer, and Uber already has capacity in terms of the amount of riders who want to use one. So I remain bullish, Steve, and I refuse to abandon the stock.
All right, Uber shares up just about 0.5% right now. Time for our headline. And welcome back to Halftime. We're back with Josh Brown's best stocks in the market. Josh, what are you looking at today?
Can we talk about Morgan Stanley, MS? This is a best name right now. It's been for a while. Look at that uptrend starting from May. Almost perfect. We had a violation of the 50-day moving average, but then a little bit of a kick save here in the high 150s. I think the stock is good right now. You got it at about a 9 or 10 point discount from the high. This is, over the last 15 years, been one of the most transformative stories on the street. They had a sweetheart deal to buy part of Smith Barney, then they were able to buy all of it. And in that transformation, they basically became the heavyweight champion of wealth management amongst the Wall Street banks. They're doing deals like buying EquityZen. They bought E-Trade a few years ago. Every time they do something, it's additive to the funnel of where they're going to find their next million clients from for their wealth managers. The big surprise this year has been the return of the IPO and M&A and all the deregulation on Wall Street. And when you look at the numbers they're reporting at the investment bank part of the business, they're blockbuster. Every deal, every IPO, Morgan Stanley is on the cover of the book. Every big M&A situation, they're always representing at least one of the parties. And their pipeline, from what it looks like, is more robust now than during the 2021 IPO boom. And the deals are higher quality. So I think this is a name that continues to beat expectations. Wealth management revenue in the last quarter was up 13% year over year. That's now an $8 billion quarterly run rate business and going higher. Client assets are at $8.9 trillion. They publicly stated their goal is $10 trillion. I think they'll get there. And they manage succession really well. James Gorman did an incredible job. Now it's Ted Pick, continuing the same momentum. And so technically, I think the stock is right where you'd want to take a shot on it. Fundamentally, I think this is a company that's got a very bright 2026.
Josh, calling Morgan Stanley. Heavyweight champ. What was the heavyweight champ of again?
Wealth management on Wall Street, for sure. I mean, this is the most advisors and the most profitable business.
All right. A lot of bank ownership. None of you own Morgan Stanley. Weiss, I'm going to start with you. Goldman Sachs. He says the heavyweight champ of wealth management. Your take on his pick of Morgan Stanley as one of his best stocks in the market?
Yeah, look, it was always a puzzle to me why Morgan Stanley had lagged so meaningfully the move in Goldman, and now it's catching up. Fortunately or unfortunately, I own so much of Goldman, I feel that adding Morgan Stanley would be making the same bet yet again, even though they're different dynamics. I'm more likely to add Citibank. Jane Frazier's done a phenomenal job, but right now I'm just staying packed with Goldman, which is one of my largest positions.
All right, Kev, you own JP Morgan, so do you. Just going to start with you, though, Kev. Your take on Josh's pick?
Yeah, I would say Morgan Stanley would be our third in the tier or the hierarchy of the names. We own JP Morgan, Goldman Sachs. Had them both for over a decade, but love everything that Morgan Stanley does. And I agree with this as a tremendous stock and a great opportunity. If you're not exposed to this space, please take a look at it.
Mr. Seachin.
I'm just going to talk about the financials since you hit some of the things that we own. We remain overweight financials in all our portfolios. There's solid earnings momentum, consumer fundamentals, reasonable valuations, increasing returns of capital to shareholders, a lot to like for long-term investors, especially as the capital markets continue to open up. I think you got to watch closely the economic environment, though, because they're inextricably linked to that. Our largest holding, to the best of the best, is JP Morgan in this space.
All right. Take a look at Morgan Stanley right now, pulling back a bit. Also, one other stat, the XLF ETF pacing for its third straight down month and also having its worst streak since October of 2023. All right, coming up, the not-so-friendly skies. Two of Josh's air taxi plays are taking aim at each other over claims of corporate espionage. We're going to debate that coming up next. Stay with us. Calls and some stocks on the move. We're watching shares of Joby Aviation. So that company is accusing its rival Archer of using stolen information from a former employee to, quote, one-up a partnership deal with a real estate developer. In the lawsuit, Joby says this is a quote, corporate espionage, planned and premeditated. Archer calls the suit baseless. Josh, your take.
All right, so I'll let the lawyers handle that. I have no idea what went on, but it seems like there's one guy who took some files on his way to join Archer from Joby and left some files unlocked, they're alleging, that allowed him to access it. I don't know. I don't care, really. I own both. I have a bigger position in Joby than Archer, but they're both small positions. eVTOL 101, basically these companies are a few years away from commercialization. There's no revenue here yet. However, Joby did acquire the blade business, which does bring in some revenue. It's not eVTOL revenue yet. They're still operating the heliports on the Hudson River and the East River in Manhattan. But the idea is ultimately they'll replace the helicopters with the eVTOL. That's an electric vertical takeoff and landing vehicle. Basically, Joby is in the lead here. I think most people would acknowledge that, but it's very early. They were all at the Dubai Air Show over the last week, and we got to look at the product itself now operating in the United Arab Emirates, and they're signing deals in Saudi Arabia. And you're going to see these things. I just don't think you're going to see a lot of them. So if you're investing here, you have to be patient and you have to tolerate high volatility. Last thing on this, Toyota owns 15% of Joby, and Toyota will be their manufacturing partner. I think they spent like $900 million to invest in the company, and that's a really key relationship. One of the largest mutual fund shareholders is Baillie Gifford. If that name sounds familiar, these are the Scottish lunatics that made a huge bet on Tesla like 15 years ago and turned that into $29 billion or something, like one of the biggest home runs ever in the history of investing. They own 6% of Joby. So they know a lot more than I do, and I'm following some smart money into these names.
Yeah, by the way, you can call it an EVA too, like an electric vertical aircraft. So you don't have to, eVTOL is so clunky. But by the way, Weiss has been waiting to respond to everything that you just said. So Weiss,
no, I'm not waiting to respond. It's just funny. And, industrial espionage is alive and well. And the idiocy of these employees, we're involved in a lawsuit where an employee downloaded all our proprietary information. And during discovery, we found it on his new employer's server. So complete moron who doesn't realize there's a digital trail on both sides. So it's always
I think we better
mind-boggling.
let the lawyers handle this one, too.
I'm a
Let's
lawyer,
bail
don't
out.
forget. Don't forget I'm a lawyer.
All right, coming up next time for Final Trades. Rob, you're up first.
Vistra Corp, VST, it's pulled back 25% over the last few months. We continue to be overweight based on the great secular growth opportunity in data center, and our view is the biggest bottleneck in the ecosystem's energy.
Weiss, you're up next.
What was that accent, Vistra called? What was the accent?
It's a Pittsburgh accent, a city of winners.
I'm going with Leidos. Leidos haven't talked about for a while, but they are in a sweet spot that the Department of War is looking to capitalize.
So eloquently
Technology.
put, Steve.
Thank you very much.
You're up next.
I'm from Manhattan.
Walmart, amazing earnings. E-commerce is expanding. Membership model is growing, and management gave us strong forward guidance.
Josh?
Zoom reports on Monday. Revenue should be up 3.1%. Earnings should be up 4.1%. Anything above that, I think the stock works.
All right, that's going to do it for halftime.
And welcome to Closing Bell. I'm Mike Santoli in for Scott Wapner. This make-or-break hour begins with a relief rally to end a choppy week as the bears take a breather and investors attempt to rotate away from danger and some AI plays and crypto and toward more stable stocks. A less hawkish tone from New York Fed President John Williams taking some of the pressure off the tape. That was this morning, alongside some dip buying in consumer plays and a continued bid in healthcare. So take a look at the key indexes right now. The S&P 500 up about 1.4% and recapturing just about half of that steep intraday drop from yesterday, while remaining down more than 1% for the week. The Nasdaq is pretty much keeping pace there. It's up 1.5% as well, although it is farther from its high than the S&P is. The small cap Russell 2000, as well as the equal weighted S&P 500, both up more than 2%. In fact, the Russell up more than 3% on the day, which takes us to our talk of the tape. Has the market had enough of a flush this month to reset positioning into the home stretch of 2025? And is today's rotation worth playing or fading? Let's ask Avery Sheffield, Vantage Rock co-founder and CIO, and it's good to see you.
Great to be here.
So we had this sort of 5-ish% pullback in the S&P. A lot of the more aggressive speculative parts of this market really got purged. Market making a bid that was enough right here. How do you see it?
So I think it depends on the stocks. So I think in those more speculative stocks, the market was taking out some froth that maybe should have never been there in the first place. Along the way, it did also take money out of cyclicals that if the Fed is a bit more lenient, if there's any weakening, actually could set up for a really nice 2026.
Many things going on at once, as there usually is when the market pulls back like this. This rethink we're having of the AI trade, I mean, it's interesting because you go back a month and a half and all the talk was it's a runaway AI bubble, and all that talk got people worried about what that might mean. And now you have a lot of stocks down a ton and people are trying to figure out winners and losers. How do you think about that?
Yeah, so I think that what's different now is that there is visibility to potentially there being winners and losers, whereas before it was considered to be all winners. And, I was at a dinner last night and we were talking about like the AI bubbles, the AI bubble bursting. But if you actually look at the stocks under the surface, it's maybe the open AI bubble that's bursting, right? Google is near all-time highs. Right. And the whole Google ecosystem is actually held up much better. So I think the market is making a call that maybe, one player, multiple players might do better than others and rewarding them accordingly.
What does that mean? I don't know if this is an area you play. I mean, we just heard about maybe the administration is going to allow NVIDIA to sell its newest generation chips to China. But the whole AI food chain kind of got hit yesterday despite a pretty, what seemed reassuring quarter from NVIDIA.
Yes, I mean, I think here what we have is like the law of large numbers, right? They had phenomenal results. But, Jensen Huang had already put out the $500 billion of revenue by the end of next year. And he said, there's upside to these numbers. But these numbers are so astronomical that it's really hard to have confidence that that's going to continue forever, right? So 2026 looks to be absolutely in the bag. 2027, maybe a bit more of a question mark. Even if the demand is there, is the supply chain actually able to catch up? And I think there are some question marks about that. And then also next year, we're going to, at some point, there might be more questions about the significant cash burn that you're seeing by some players like OpenAI. And so if investors in those companies are questioning the free cash flow generation. 6 months from now, they might not be willing to fund the next round of capital. And so you might be limited to more of those very cash generative companies buying chips, which might mean demand doesn't accelerate at the same rate moving forward.
So do you think that the market in this last period is roughly getting it right as it tries to sort of navigate those issues?
For now, I think it's moving in the right direction.
Yeah.
I think the one thing about AI that's clear is that the perception of winners can change very quickly,
Sure.
right? So right now we have a perception of Google being a potential real leader with the Gemini 3.0 model and them putting out a price that suggests they have real pricing power and technological superiority. But should you have, for example, OpenAI come along and present, an advertising model competitor to Google, like people's perception might change. But for now, I think the market is reacting to the realities.
All right, welcome back to CNBC, everybody. As you probably saw, we had a couple of just minor technical issues there. Not a big deal. You know what's not having a technical issue? The stock market. Yesterday, obviously, we popped at the top, and then we saw the markets go down. We lost about 4.5% on the NASDAQ, ended right on our lows. Well, a lot of that is being gained back today. Still, we're headed for a down week, but overall, we are seeing markets today in rally mode across the board. NASDAQ's up 1.5%. The Dow is up 1.4%. And really, maybe the most interesting part of the stock market are the Cindy Brady's, right? Or the Bobby Brady's. That is the small cap stocks. You look at the SML, you look at the Russell 2000, up more than 3%. These are some of the largest gains that we have seen for small cap stocks. And maybe the small cap stocks are doing so well because of some changes in the way we think about interest rates. And on that topic, we got some very interesting comments today from Fed Governor John Williams. Let's send it now over to CNBC senior economics correspondent Steve Leishman, because I feel like these Williams comments, Steve, they really turned a lot of thinking around.
It sure did, Brian. It's a really good observation. I'm calling this on second thought. A week's worth of hawkish speech from Fed officials gets ripped up, torn up, thrown out, and today by a single line in a speech by the influential New York Fed president. Williams making just one comment about Fed policy in a speech in Chile saying, quote, I still see room for a further adjustment in the near term is what I'm emphasizing, to the target range for the federal funds rate to move the stance of policy closer to the range of neutral. Near term could mean January, but it could also mean December, which sent Fed fund futures soaring to 60% probability of a rate cut from 33% before Williams spoke. And of course, likely played something of a role in this market rally, which looked to be more concerned about a quarter point cut than it appeared to be, at least earlier this week. Krishna Guha at Evercore ISI suggests Williams' comments would not have come without a sign-off, Krishna says, from Fed Chair Jay Powell. We don't know his views specifically on a December cut. Guha called Williams' remarks a leadership steer. And now the question is how many voters, quote, follow the leader. As you know, Brian, as a musician, I'm skilled in what to do with technical difficulties. And the answer is you sing louder.
Well, you sing louder and you say, look over here. But let's go back to your band reference before I send it back to Mike Santoli, who is there. And because you've got the lead singer, you got the lead guitarist, you got the bass players kind of in the back. I would assume because John Williams is moving the market to this effect that he is seen as maybe not lead vocalist, that's Jerome Powell, but he's got to be up there because this is one of 9 whatever voting members. Why is John Williams moving the market with those comments?
It's a great question, Brian, and the answer is this. Sometimes the chair will send out a vice chair, or in this case, the president of the New York Fed. We don't know this to be true, but this is something that's happened in the past. Call it the intellectual pulling guard for the chair, where what his job is to do is kind of clear the defense out of the way, set things right, and be in front of the chair carrying the ball, and kind of create the opportunity for the Fed chair to come in and redirect the markets. We haven't heard from Powell. I don't know that we're going to hear from Powell before the next meeting, but I think that's what's happening here. It could be that John Williams is speaking on his own for himself and that others don't follow. I don't know if we have that board available, Brian, but we've had a lot of hawkish Fed speak. We've been on your show how many times this week talking about it, watching those probabilities fall, and the reason is because John Williams is part of the leadership leadership of the Fed. And the thinking among many is that he's really speaking, or at least clearing the way for the Fed chair to try to implement that December cut.
Well, I love it. And Steve Leisman, I feel like you're the Grateful Dead in 1977, because every other day you're somewhere else. The epic tour of the Federal Reserve, rockin' Cleveland, rockin' Boston. Steve Leisman, thank you very much. All right. Mike Santoli has replugged in the wire he apparently tripped over.
Right.
We're going to send it back to him at the NYSE.
You will be able to buy a cassette of all this in the parking lot someday, Brian. Thank you very much. Appreciate it. Meantime, Vantage Rock's Avery Sheffield still with me. Let's bring in Neuberger Berman's Shannon Sikocia and Hightower's Stephanie Link as well, both of them CNBC contributors, of course. So let's just, Avery, just quickly react to this idea that the market was tensed up about the idea of a Fed mistake if they go on hold in December, maybe some softening up at the labor market. Is this enough to reassure things?
I think that comments of Williams today do suggest that if the market has too much of a sell-off, they'll probably come to the rescue as long as the economic data is softening. So that does suggest some support, especially to these cyclical names.
Yeah. And Shannon, I mean, just more generally, the market obviously dealing with these compound issues, a bit of a growth stock, overshoot to the upside, getting unwound, and now the market figuring out what happened to the fourth quarter rally. So how are you thinking about that?
Well, we're getting a lot of questions from clients, Mike, about what is driving this.
Yeah.
And I think that the challenge is now is that there are just a confluence of factors. And unlike other periods this year where we've had a confluence of sort of positive tailwinds, you're just getting a lot of wind in the face right now. If we look at positioning, there's always a drive in this fourth quarter for portfolio managers to really look to buy some of these winners. But at these valuations, it doesn't feel as comfortable. We're also going into 2026, and many of us, including Neuberger, we're looking at 2026 as an opportunity, to Avery's comments around cyclicals, small and mid-cap names, looking to find those AI adopters rather than AI enablers. And so you're looking at sectors, Mike, like healthcare, financials, industrials, wanting to position your portfolio for 2026. And so that has to come from somewhere. We talk a lot about cash on the sidelines. If you're an equity portfolio manager, though, you're probably pretty close to fully invested, and so you're trimming off some of those names, particularly if they feel like they've run a little bit and gotten a little bit long in the tooth this quarter. I think the rate story will help. I think that getting some more clarity around how many cuts we get and where that neutral rate ends will certainly benefit those cyclicals, but I think it's just a number of things at this juncture.
Sure. And Steph, we come into this period after a very good earnings season, right, where essentially that piece of the puzzle fit in pretty well. As a matter of fact, we now roll forward our 12-month estimate of S&P 500 earnings, and with the stocks pulling back, magically we're down under 22 times earnings again on a forward basis. So I guess in a sense you've de-risked the market a little bit, but within the market, where have opportunities surfaced? I'm looking at equal-weighted industrials up 2.4% today after they looked pretty tenuous yesterday.
Yeah, I mean, first and foremost, you mentioned earnings. Earnings are up about 12%, and they're probably going to do that this year and maybe even next year as well. And a lot of that has to do with, though, Mike, that it's driven by a stronger economy. The Atlanta Fed tracker today came out at 4.2% for the third quarter in GDP. And I know that a lot of it is AI related, probably 70% or so is AI related, but it's throughout a number of different industry sectors, companies that are driving this. That's number one, and that's one of the big reasons I don't think you're seeing a bubble in AI. But number two, the consumer is hanging in. The consumer has been resilient. Yes, they're being choosy on where they spend and what they spend, but they are spending if you have the right products and the right services. When you add all that up, I don't even think we're kind of obsessing about the Fed and cuts in December. I don't even think the Fed needs to cut. We would like the Fed to cut. But if you see higher inflation because you have higher growth, that actually is positive for earnings. And that's why I feel good about earnings. I think the fact that we are still up 30% from the April lows, even though we've had a 4.5% pullback, that's still remarkable. That's remarkable in terms of what we have seen. And at the same time, you have very negative sentiment. You have the fear and greed at 7. You have the S&P oscillator -4. You have the VIX up 41% in 10 days. So any piece of news to turn the narrative around, you're going to see rallies like this.
For sure, yeah. I mean, we came into the day looking a little bit stretched to the downside, at least on a short-term basis. Although, Avery, I guess when those conditions take hold, the question is always, are we going to see something even messier? Do people have to just continue to shed risk? Bitcoin has become the fixation, if only as that kind of risk appetite tell how much portfolio stress is out there. Can we maybe get some comfort in how the market's acting today around that?
So the more speculative areas of the market might continue to see weakness.
Yeah.
I'm not sure because liquidity is very tight, right? Even if the Fed cuts 25 basis points next month, like I don't know that that's going to be enough to meaningfully increase liquidity. So I think we're more likely to see like this rotation potentially taking money out of winners, out of speculative stocks that are really priced in too much,
Sure,
and going into companies that are undervalued that really have some interesting catalysts ahead.
Shannon, I'm kind of one of those out there who's saying everyone says they want a broader market. This is sometimes how it looks and feels in the process of it becoming broader, right? You have 35% of market cap in 7 stocks. Almost everybody agrees that's too much. It comes out all at once, and the indexes don't always take it easily.
Well, interestingly, we came into this year, Mike, thinking about the potential deterioration in earnings growth for the hyperscalers, for instance. And so really looking to close that delta, if you will, between the earnings that we were seeing in tech and every other sector. Instead, what you've seen is everything sort of move up to the right together. And I think so we were concerned about this, and I think we were better positioned for this in terms of narrative early in 2025 than we feel right now. But it's not different than maybe what we had talked about earlier. There needs to be some rotation. There needs to be opportunities for this repositioning.
Sure.
And yes, it's going to feel a little bit difficult. I think more importantly, though, it might be able to wash out some of this really speculative AI adjacent exposure that many people have probably let build up a little bit too much in their portfolio. So I think that for us, in our outlook, this is what we were expecting. We perhaps expected it earlier this year. But I think, again, we've also given an opportunity where if you look at small cap stocks, for instance, the earnings outlook for 2026 looks a lot stronger.
Yes, that is coming through for sure. And Steph, there has been a lot of distinction even within the Mag 7, as everybody knows by now. I mean, Meta's had it rough. Alphabet is now larger than Microsoft in market cap as of today. And we were just talking a little while ago about how if the market decides Alphabet is kind of got the pole position, it might not be that great for the whole infrastructure food chain, but then, of course, the pendulum can swing in favor of somebody else along the way. So I know you own Meta and think about the space, and how would you position around all that?
Yeah, well, I think with an RSI of 23 at Meta, I think it's way overdone and way oversold. And at the flip side, Google goes up every single day with an RSI of 64. So it's getting a little extended. I think there are plenty of winners in this space. I think all the Mag 7s, all the technology companies that are spending $431 billion in CapEx, they will see monetization, number one, return on their investments, number two. The reason I've chosen to buy more Meta is because we are seeing it with impression growth of 14%, time spent up 5%, and video time spent up 30%. And you're seeing better pricing of about 10%. That's monetization. And I can't believe that people are willing to sell that. And they've sold this thing now down 25%. In terms of your question to me earlier that I did not answer is where else am I going? Honestly, I think you still want to be in financials. I am watching the industrial data center companies and the build out of the grid. Those companies are winners as well as the NVIDIAs of the world, the semiconductor companies of the world. So I'm absolutely keeping my eye on Quanta Services, Vertiv, Eaton, Rockwell. Those are winners as well with double-digit backlogs, which is really important, good visibility.
All right, we will leave it there. Really appreciate the conversation to wrap up this week.
Hello, everybody. Welcome to Blue Cloud Trading. I'm George. It's Friday. It's November 21st. It's 4:26 p.m. Market is closed, and it was up. All indices were up today, which is great. We just saw Josh Brown and other guests on the halftime report, some clips from Closing Bell. And what we're going to do now is go over a number of the stocks that they talked about in a few seconds. But let me just show you a little list that I've got here. So we're going to go first, of course, into the index ETFs like the S&P 500, which is the SPY, the QQQ, the Dow, the Russell, the VIX. We're going to look at FEZ, the Euro stocks. We're going to look at about 12 CNBC stocks. We're going to look at some of the Mag 7 stocks. Okay, we're going to like Apple, Tesla, Meta, Microsoft, and Amazon. We will look at the sectors. Okay, and I've got them highlighted by the strongest by that little blue flag that you see right there. And then we'll look at one of our members' requests, WPM. So let's first, before we get started here, what I like to do is take a look at these indexes. Okay, and as you can see, the Dow up 1.08%. It was kind of flat in the early part of the day in the morning. You can see right there, it broke that little base that it was building and continued moving up, creating a higher low, and basically stayed above that level for up 1.08%. The NASDAQ was up 0.88%. This one was actually pulling back. It was a negative territory in the early part of the morning, and then it broke back above the prior day's closing price. It moved up, creating a higher low, higher high from the prior high, and so it was up 0.88. S&P 500 did something similar, and it was up 0.98%, and the Russell 2000 actually never got into negative territory. It basically created that base, and around 11:30 or so, you can see that candle that led the jump, and up it went. So let's look at the heat map real quick. This is going to show us how the individual stocks in the S&P 500 performed, and you can see that, well, Microsoft, Nvidia, a lot of the technology stocks still dropped a little bit today. Like Oracle was down 5.66, Microsoft down 1.32, Nvidia down 0.97, Broadcom down 1.91. So the semiconductors and some of these large technology companies not doing so great. Tesla was actually also down 1.05%. Netflix, Walmart, RTX, GE, some of the utility stocks were down. But look at all the green today. Google was up 3.53%. Amazon was up. Apple, all of the healthcare stocks, got very bullish today. Basic materials stocks did well. Real estate did well. Utilities were mixed a little bit. Financials did well. So, this is a great thing to see, especially at the end of the week. Let's look at the 1 week performance. This is the 1 day performance for Friday. Here we go. So this is what it was a down week for the majority of the stocks. Google was up 8.41%. The healthcare stocks were looking really good. Some of the consumer defensives were up. So that's basically what we've got going on here. If we look at the groups, the sectors, all right, and let me zoom in a little bit. Here we go. The 1 day performance, you can see healthcare took the lead once again, up 2.06%. Utilities were down the most, just up 0.09%. Technologies up just 0.12%. Technology. So that's interesting, right? Communication services and healthcare, the top week performance sectors. And then technology was the worst performer for the week. How about for the 1 month performance? It's healthcare. Again, 4.92%. Technology, the worst performer for the month. For the entire month, down 5.8%. Okay. 3 month performance. Healthcare, once again, up 12.65% versus technology, which is only up 3.5%. And for the half year, look at this. Communication services has taken the lead. Technology, okay, under that at 20.4%. And for the year so far, we can look to see communication services and technology have been the highest performers, okay? All right, so let's get into these to the technical analysis of these ETFs and sector stocks that we just talked about. Remember that this weekend I'll be doing another members-only video if you want to see that, where I go over my entire portfolio and I go into a little bit more in depth about the sector analysis that I do. I also give 20 new stock ideas based on a proprietary scanner that I use that helps me identify some great stocks. And I also do a really deep dive into the strongest sectors and industries. It's really important to do a top-down approach when you're approaching, trying to figure out what to start leaning into going into the next upcoming week. So, and I share all that with members. And the way to do that real quick is just by hitting the join button right there, which is next to the subscribe button. So it's free to subscribe. Don't forget to subscribe and hit the notification bell so you get those notifications when I put a video out. Hit the join button if you want to access the member-only videos. You would have to become a Blue Cloud Trader level member, and then hit the join button there. If you want to get daily trade updates on all my trades every day, Blue Cloud Legend level member. Select that third tier, okay, and hit the join button. All right, let's get back to the charts for a moment. So the S&P 500, guys, check this out, okay? Like I said yesterday, all you got to do is go back to yesterday's video, the one with Tom Lee on the cover, okay? I said this is a really important point, the 652, right? 652.84 level. It's based on that prior low there. You can see we also had the cloud, the bottom of the cloud as a level of support. I said this is where we are going to have to see price stall. If it breaks under, we're in trouble. Okay, it's almost like they listened to me. I doubt they did, but obviously. But what we have right here is price, in fact, stalling and creating what's called this is a bullish harami. It's comprised of these two candles right here. It's when you have a large red candle, like the one we just saw yesterday, and then a smaller baby candle, all right, within the body of the prior one. That's called a bullish harami. In Japanese, harami stands for pregnant. So it's easy to identify this pattern. All you need to do is look for the large candle followed by the small little bullish candle. And if you see this at the end of a move, it's generally a very bullish sign. There's a higher probability. There's no guarantees, of course, that price is going to definitely go up on Monday, but there's a higher probability now because of this. Why? Because price actually stalled. Price, in fact, from yesterday's closing price, it gapped up, continued moving up for the S&P 500, okay? And remember, on the weekly chart, let's look at the weekly for the S&P 500. This still was a pretty negative week here because we did, in fact, we did close under the 9 period, right? Okay, but overall, if you look at the big picture here, we're still above the cloud, which is what's important. We want price to be obviously above the Ichimoku cloud. We want it to be above both of the moving averages. Right now, we're only above one of them, the 26 period. And the Chiku span, which is the closing price projected 26 periods ago, that white line right there is above the candle 26 periods ago, or 26 weeks ago. So that's all looking good. On the S&P 500, you can see that the Chiku span, the white line, is actually under price. And as I've mentioned, we're looking at a head and shoulders pattern here, which could still potentially drop. I mean, there's the head, there's the shoulder, there's the other shoulder, and there's the neckline. I think that 652.84 level is pretty much that. And if we see price dropping under, expect it to go down to the next level. We're talking about the next level where it should find some support on the daily chart would be the 200, in my opinion. So that's around another 6.8% potential drop. But again, on Monday, my expectation is that we're going to see price jumping. And this bullish harami, you can find this pattern. I've got this cheat sheet, guys, that I use. Let me show you real quick. If you go to my Twitter page, all right, you would have to go to my Twitter page, which is @BlueCloudTrader, so x.com, and then you'll find me at Blue Cloud Trader. If you scroll down a little bit, you can see some of my posts. And then, okay, so you would basically find the posts here. And then what you want to do is select this, the highlights tab. Scroll down a little bit, like 3. There you go. And there's the candle pattern reference sheet. This is what it looks like. And this is where you can find all those patterns that I'm talking about, like the bullish harami. Let's see, where is that? Right there. There's the bullish harami, okay? The bullish harami. These are the double candle patterns, tweezer bottoms. You got piercing line, bullish engulfing. Okay, bullish kicker. It's good idea to memorize these and also understanding how the candles work, right? The opening price, the closing price when it's a green candle. The wick represents how high the price moves throughout the day. The bottom wick represents how low the price moved. So if we're looking at a daily chart, this would be 9:30 a.m. Okay, this would be 4 p.m. If it's a red candle, okay, the body is 9:30 a.m. Okay, and this is 4 p.m. All right, the wick represents the same on both candles. It's the high of the day and the low of the day. So it gives us some information that you might not otherwise understand unless you figure out how to like read these candlesticks. Secondly, look at the single patterns as well, like the spinning top. All right. Now that can be, depending on where you see this, If you find something like this at the top of a move, at the very, very top after it's moved up, it's bearish. If you see a bullish spinning top like this at the bottom after a drop, that's very bullish, okay? And then you've got the hammer, the inverted hammer, the dragonfly, hanging man at the top of the move, shooting star at the top, gravestone doji, just a few, okay? So let's get back now to the charts. All right. So here's the S&P 500. Let's take a look at the Qs. The QQQ ETF did the exact same thing. We've got a bullish harami right there too. I mean, you have to admit, this is pretty interesting. Price actually dropped under the cloud, temporarily pierced it with that wick right there, and then price, the bulls stepped back in and pushed it right back up, as you can see right there. So that's good. That's a good sign. The Dow Jones up 0.98%, another bullish harami. That's why I brought up this the pattern reference sheet so you can see what I'm talking about. Okay, these two candles. So it looks like it also closed right back above the cloud. That's a good sign for the Dow. Russell 2000, IWM. Now, it's been in a decline for a while. And yes, it did also create a bullish harami, but it's also stalling right at the bottom of the cloud. So it's got resistance right here. All right, so there's a higher probability that the other ETFs will do better going into next week, but we will see if I'm correct about that. I wouldn't get too overly excited about this. It's just that the Russell 2000 is a little bit more volatile, okay? And so you're going to see higher percentages when it does move up, and you'll also see higher percentages when it drops. Right now, the technicals aren't looking particularly great here. We've got a bearish future cloud as well. Single span A, the light colored part of the cloud has dropped under. There was a crossover right there under the Senko span B, so that's bearish, okay? And this is what the weekly chart looks like. Now the good news is it does look like it stalled right at the Kijinsen, the 26 period on the weekly. All right, so that's a good sign. So we'll see what happens. We gotta wait and see, but we're ending the week in a positive note, so that's good. And the good news is that we also did not take out, like I was concerned about, you know, the VIX continuing to move up, more fear coming into the market. If the VIX got above these levels, around the 28 level, okay, did not happen today. You can see it gap down, maybe it moved up a little bit and then finally closed, but it's still above the cloud. It's still above the moving averages. Down 11.32%. This represents volatility, it represents fear. We want to see this dropping. When this is dropping, the market's usually moving up. FEZ, the Euro stocks, also a bullish harami right there. So it closed temporarily under the cloud yesterday, recovered today. So now it's got a higher probability of moving up. It will still find resistance at the cloud. It will still find resistance at the moving averages there, which are at the exact same spot, as you can see. That's the interesting thing about the Ichimoku moving averages, because they're taking the midpoint of the candle. So what it does is it looks at the high of the candle, the low of the candle, divides it by 2. It's actually the middle point. And then it's the midpoint of the last 9 periods. And that's where you'll find the green line. And the 26, it also takes the midpoint of the 26 periods. That's where you'll find the red line. They've actually merged right now. So they're at the same exact level, making it a much harder level of breakthrough. So we'll see what happens there. Okay, now, guys, regarding the stocks they talked about on the show, on the halftime report, I mean, there's something off technically about every single one of these stocks, even though some of them were up, like ACHR was up 4.5%, but I'm going to show you they're not looking that great. ACHR, Archer Aviation, it's been in a embedded decline for a little while now. Okay, you can see that right there. Yeah, we get a bullish candle, but you know, we got one over here too. We had one right here. We had a bullish engulfing pattern right there. It you know, until you break above the cloud, I would hold off on taking any new positions in these stocks. Impossible to identify when this thing is going to start turning around. All right, so what you need to wait for is strength to come back into it. You need to see more buying. You need to start seeing higher highs, higher lows. When you start seeing that, you've got something. You're also still into the 200-day moving average. CEG, Constellation Energy. And I've had a position in this back. I had Added it back on August 4th, closed out of it on October 20th on that candle right there. It's been dropping. It's been dropping since. So it's under the cloud right now. This is also bearish. Stay out of that one. GE Vernova is under the Ichimoku cloud. I'd stay out of this one. You can see it's also consolidating right now. It's just kind of stuck in that little box. Nothing to do here, folks, with GEV. What about Goldman Sachs? Also, just basically consolidating. There's no momentum. There's nothing going on with it. It's just, you can see that the directional movement index isn't really moving in any one particular direction either. I'd stay out of Goldman Sachs for the time being. If we start seeing some strength, I'll let you guys know, obviously. Bitcoin, there's the decline. I mean, we got early warnings about Bitcoin on the daily chart here when price got under the Tenkan-sen. That happened on October 10th. And since that date, if we just look at the closing price, it's dropped 27.47%. And mind you, there hasn't been another opportunity where you should have been adding positions, because the entire time since this date right here, actually this was the last time that it closed above, sorry, this candle right here. So, but since this candle, there hasn't been another opportunity. I want you to notice them when I zoom in. What happens to price when it does come close to resistance levels. All right, so basically dropped here. Okay, continue to drop. It did find some support close to the 200-day moving average. It moved back up, but what happened? It stalled right at the cloud. Dropped, came back. What happened? It stalled right at the 26 period and the cloud. The top of the cloud right there. All right, dropped. Stayed under. Tried to recover right there, was unsuccessful in getting back above the 9 period, the Tenkan-sen. Dropped. Notice how price kept on hugging this moving average. It hugs it better than any other moving average that I've traded with different moving averages, traditional ones, like based on the closing prices. I've used exponential moving averages. I've used it all. Ultimately, what it comes down to is that this particular indicator, for whatever reason, and maybe because it was incepted at such a long time ago, believe it or not, in the late 1930s is when the person that started developing this put it together in Japan, and then published this indicator in the 1960s, late 1960s, and then it became popular here in the United States in the 80s. And prior to computers, they had to do this all manually, just draw it on can you imagine having to put that together? But it's all based on mathematical equations, and it works. And guess what? I think a lot of financial institutions are using this as well. It's just my intuition here based on the way that it reacts to certain levels. At least that's what I found. Now, what do we have here with Bitcoin today? It was down 2.02%. It did gap down, but it created a bullish candle. You can see that bullish spinning top. Now, this could turn into something, certainly. If someone was shorting Bitcoin, I'd say, take your profits, get out of that right now, and not, because this thing could certainly pop next week. All right, it's taking a big beating here. Let me see where the next level of support is. Technically speaking, it looks like let me look at the weekly chart. Okay. Oh, that's interesting. So here you can see on the weekly chart, IBIT, which is the Bitcoin ETF, is coming to a level of support. The Senkou Span B, the bottom of the cloud. So, and there is a little bit. See that wick right there? That represents the buying that happened, where it moved up a little bit today. So we might see Bitcoin recover next week. All right, I wouldn't be too shocked about it. It has dropped quite a bit. All right, let's take a look at Joby Aviation. This was Josh Brown's final trade back on July, and on November 7th, when he did bring this up on the show on November 7th, which was, I think, this candle right here. Yes, that was November 7th right there. It was, in fact, a bullish candle. After the drop, okay, if you're looking for a short-term trade, I suppose that could have worked out potentially. It did move up slightly, but look where it stalled, right at the cloud, and dropped. So that's why one of the main rules of Ichimoku The Ichimoku indicators do not add positions when you're under the cloud because they could be very short-lived, these moves up. And then you can see it's dropped. Now, since that call right there at the close from the November 17th, it's dropped 12.8%. Now, we've got a bullish candle here with that long wick at the bottom. It might turn into something, but I wouldn't be betting on it. And here's the weekly chart. This week it closed under, okay, it closed under the Kijun-sen. Let me just check something else out. It's staying above that level, so that's a weekly level. Let me color it blue. Something that can help you when you're drawing your support levels and resistance levels is if you're looking at a specific time frame like the weekly, have a different color for it. I like to use blue for the weekly and a light red for the daily. So it's found support. It might bounce next week. Would I be jumping into this? No. LDOS, Leidos, Holdings. No on this one. 2 weeks in a row where it's under the 9 period there. And then on the daily chart, it's inside the cloud. So no on that one. Morgan Stanley is also inside the cloud. So no there. Uber, okay, has had a big drop here since the 101.99 level. Okay, it's dropped approximately, let's see, where does that? Around 17.9%. We've got a bullish candle right here. This could turn into something. All right, that right there looks bullish. It's a bullish hammer is what it's called. But I'd stay out of that one. All right, just stay out for now. Okay, let's see what else. VST, Vistra, that's also under the cloud. Stay out of that one. It's under the 200. Walmart, we talked about this yesterday actually because they did talk about it on the show. And it did come out with earnings. And I said, hey, it was looking pretty bullish. The only problem with it, right, some of the elements of Ichimoku were not in play. I mentioned that the cloud itself was bearish still. Senkou-span A was still under Senkou-span B. I mentioned that the Tenkan-sen was still under the Kijun-sen. We didn't have the bullish, faster moving average above the slower one. And I also mentioned that the Chikou-span itself, okay, was still underpriced. The white line right there. So when you've got all those things going off and you don't have confirmation, you're taking a chance. And so if you bought, you can see what happened. Yeah, it gapped up in the morning slightly, okay, but then spent the rest of the day dropping. We can see that if we switch it to a 5-minute chart. So there's the 5-minute. There we are, okay. This is the gap that happened on the 20th, and it kept on moving up after the earnings announcement. And then on the 21st, you can see how, it reached, this was the opening price right here, the dotted green line. And basically this was the prior day's closing price. Once it got under the prior day's closing price and under the cloud on the 5-minute chart, boom, dropped, came back up, found resistance, okay, dropped, continued to drop, found resistance at the top of the cloud and dropped some more. So yeah, not the time to be jumping in here yet with Walmart, in my opinion. And then you've got Zoom, which also created a bullish, well, it's not a bullish harami necessarily. This is just a bullish spinning top because the candle, the full body is not inside the candle within the next candle here. You can see the opening price was under, okay, the body of this candle, but it still looks pretty bullish. But at the same time, it also stalled at the 200, and it's got resistance above. Stay out of this one, folks. Not the time to be jumping in. All right. So those are the stocks that they talked about on the show. We're now going to take a look at. They also talked about some of these stocks like Apple, which was up 1.97% today. Let's see, did it close above 271.49? Just barely, okay, above the 271.01 of the Tenkan-sen. So yeah, I mean it did, but it's not a very conclusive pop. The other thing I would pay attention to is this prior high right there. Let's see, what is that? 277.32, and I'll just circle this as a reference point. So that's the level it needs to get above to continue moving up. We need a new breakout because right now it's just consolidating, in my opinion. As you know, I don't have a position in Apple. Tesla, still dropping inside the cloud. So I'd stay out of this one. Okay. Chico Spin is underpriced. Tenkan-sen is under Kijun-sen. The cloud's starting to look, getting more and more bearish. It's about to potentially twist right there. You've got Meta with the bearish cloud under the price, under the cloud, under the 200, looking terrible. Microsoft, yes, it's been in a decline. Is it finding support? It looks like it might. We've got a few things happening here. We've got the 200-day dotted yellow line right there. That's an important level. We've got the 468.35. That's the purple line represents the monthly. Let's look at the monthly. How did I come about with that? So, yeah, it's based on that candle right there. 418.35. That goes all the way back to 2024, July 31st of 2024. And once we broke above that, we continued up. Now we're retesting that prior high, okay, on a monthly level. Here's the weekly. You can see it pulling back. Will it bounce here? It looked like it stalled right at it. It's a little bit of a wick. Let's look at the daily chart. See how it touched? It literally touched it and then retreated. So let's see the 5 minute. Okay, there it is. Look at that. Wow, that's pretty impressive. If you take a look at when I created that, it says it right there in the box. If I highlight it, created May 6th of 2025. Okay, so that's interesting. The fact that it stalled at that exact level, not during even on the 5 minute chart. We're talking about a monthly level because these are very powerful levels. The monthlies more powerful than the weekly, and the weekly, of course, is more powerful than the daily, and so on and so forth. Right? The higher the time frame, the more important the trend line is. So right now, yeah, I don't know. Looking at this daily chart, we might see a bounce, but I wouldn't be jumping in. Again, the part of the rules of the Ichimoku is to stay out of it while it's under the cloud. Amazon is also under the cloud, but also could find some support right here. Amazon could bounce. This one's an interesting pattern. They call this a piercing line pattern, guys. Piercing line. What do you need to make this happen? You need price essentially to drop, to gap down, okay, and then move up and close within the body of the candle. That's a piercing line. That's also bullish. All right, that's the daily chart. There's the weekly chart. I don't know if it's going to find some support. It should at the 200. It did in the past, right? It did over here, right? It did over here. So the 200 is a powerful moving average. Let's look at some of the sectors now. The strongest one, I've already reviewed all these, and the strongest are XBI, which is biotech. You can see here on the daily chart, it's still holding up beautifully above the moving averages in the cloud. This is what you're looking for, folks. Not the other stocks I just showed you that were declining, that are in a downfall, trying to, pick the right bottom. Impossible. XLV, buy into strength, right? Add to positions that are winning, not losing. Never average down, okay? You're just going to be caught up in a really bad situation in that situation. Okay, so XLV Healthcare, very strong. Let me get rid of the lines for a moment so I can see. All right, and here's the daily chart for XLV, for example, and you can see that it was building a nice little base right there, and then boom, today, Friday. So I think we're going to see a continuation, obviously, higher volume too. Now the rest of these, and this is the weekly chart for you. Okay, this is in the beginning stages too, which is great. You can see that it just recently became bullish on the weekly, where the cloud turned bullish. We've had back here for 5 weeks now. It's been above the clouds. Okay, what about the rest of these? Well, not so great. And so I'm not going to spend too much time on these because they are under the moving averages, and there's something negative technically. I'm just going to show you the charts here. Here it is in the daily. Junior gold miners. Oil K is under the cloud. Copper is still inside the cloud. XLC Communication Services is under the cloud. Bitcoin, we talked about that. SMH, this is good for semiconductors. The fact that it stalled at the bottom of the cloud here, maybe we'll get a bounce, but it's inside the cloud. Gold, it's above the cloud, just trying to find its way here. I think, it was down 0.15%, but it's just like teeter-tottering right on the top of the cloud there. Let's see what happens next week. I certainly wouldn't be buying here as long as it stays under these moving averages. XHB, home builders, is still in a decline. Under the Kijinsen, notice how we had a big up day. This could be very misleading, folks. Just looking at the percentages, a lot of people, they see that a stock or an ETF moves up like 4.68%, and it's, wow, that's a lot more than the other ETF, for example, right? Or sector or whatever it is. And so you start thinking, this is it. It's going to start moving up. Not necessarily. It could be just a one-day situation. Yeah, it had a good day, but it stalled at a level of resistance. All right. No guarantees because you have a high percentage move up. Look at Walmart yesterday. It was up over 10%, and then it dropped, gave up a lot of that with profit taking that takes place. Real estate is under the cloud. Consumer discretionary is under the cloud. Utilities is inside the cloud still. It could find some support here and pop maybe next week, possibly, but I'd stay out of that. Consumer staples has shown a little bit of strength here these last couple of weeks. As you can see that what's happened is we've developed a higher low from this low. That's a good sign. We've also taken out. Did we take it out? I think we did. Let's find out what the exact level is right here. From that high, it is 77.79. Yeah, just barely. 77.90 is where it got above. So that's good. But it's under the cloud. Now, if you want to be an early, you want to jump into something like this, and you're more of a active trader, and you want to get in on the action of XLP hypothetically because you have the time to during the day to just day trade. Well, then you can switch it to a 2-hour time frame, and you can see, for example, that it looks pretty good on a 2-hour time frame. It looks pretty good on a 1-hour time frame, right? It's above the cloud. It looks good on a 30-minute, okay, and a 5-minute. Well, 5-minute not so great right now, but it was, okay. That's my point. It's really about determining what time frame you want to make your decisions on. Now, it's gonna be, you got to be very overactive if you're using shorter time frames, so just keep that in mind. Okay, XLK, technology. Ooh, still staying under the cloud. We got a bullish candle. But it also stalled right at the bottom of the cloud. Did not re-enter the cloud. That's a sign of weakness in my opinion. We're going to have to see some more strength here. It's got to get above the high of that candle. It's got to get above the cloud and the moving averages. Industrials, XLI is under the cloud. No. Financials are under the cloud, but finding support at the 200. Energy, finding support at the cloud, but under the Tenkan-sen. Silver, under the Tenkan-sen, but finding support at the cloud. XLB, materials, is under the moving averages in cloud, and that's that. Okay, we just went through all those. Let's look at WPM, which is Precious Metals. Wheaton Precious Metals Corporation, a gold stock. Let's look at the weekly chart here. So what I'm seeing on the weekly is like a pennant type pattern, and I don't really need to draw lines to see these anymore. I can just kind of look at a chart and I'm like, okay, yeah, there it is right there. There's the pennant, okay? So you've got yourself a nice pennant. It's getting squeezed in here in this little range, and the question is, where is gold heading? And gold is it's kind of being secretive about its potential, where it's moving to. Because like I said earlier, GLD, if we, again, going back to GLD, whoops, hold on. There we go. On the weekly chart, it's in a nice strong uptrend, but when you look at the daily, it showed a little bit of weakness recently. We do in fact have a lower high here from this high. We have not taken out the lows, which is really critical. That's the key thing, right? We don't want to take out the lows there. So, and we need to stay above the cloud, obviously. So looking at WPM, Wheaton Precious Metals, right now it does look a little bit more bearish than the actual ETF itself because it is under the cloud. The future cloud looks a little bearish, but that 200 days right there too for support. We have not, let's see, we've got a lower, so it all kind of started here with this double top pattern, right? We took out this low, and then we created a lower low here from the prior one, and then this is a lower high from this prior high. So we're in a downward channel in essence here with WBPM. But the sector itself, it's a different story. If you look at looking at the weekly chart, it's trying to hold up in this little, and has some potential, but this was not a great week for it. Down 0.35%. So I would be watching it very closely. I would probably, maybe even look at a 4-hour time frame or a 2-hour time frame to help give you some more guidance. I mean, it gives you more information on the shorter time frames. Here's a 30-minute time frame, for example, under the 200. So you gotta pay attention to it very closely here. That's going to do it for this video, guys. Thank you for watching. If you want to support the channel, again, one way to do it is by hitting the subscribe button if you haven't subscribed yet, notification bell, share this video with someone, okay? Because then what happens is, like, when you do hit that subscribe button and the like button, it pushes it out to more people. More people get turned on to the site, and guess what? As a result, I can do more videos. I can continue to bring this information, this critical information, I think, to people. Some of you may not even be active traders, but guess what? The majority of you actually own stocks in your 401ks, your IRAs, and it's a good idea to educate yourselves on alternative ways at looking at stocks, not just based on what the pundits on TV say, these guys, but have a strategy of your own and using an indicator which, it's agnostic. It doesn't really care. The indicator, Ichimoku, does not care whether the market's moving up or down. It's just giving you the insight. It's giving you some information visually. It's telling you what's happening in real time on different time frames, and you can make a better assessment and incorporate, of course, the fundamentals, right? You want high, sales growth. You want to see profit margins. You want to look at the price of sales, of course. You want to look at all those different things, operating cash flows. That's important. But incorporate the technical side too. When you've got both of those, then you've got a more solid foundation and a higher probability of actually having a really, strong portfolio that's going to outperform other people's portfolios. That's for sure. All right, that's going to do it, guys. Thanks for watching again. Have a great weekend. Have a great weekend. And if you want to see that video that I'll be doing tomorrow, the members only video, again, just become a member. Hit that join button. Let me go back to it again. Sorry. Hit that join button right there. Select Blue Cloud Legend or Blue Cloud Trader. And then you can always upgrade too. You can try out the Blue Cloud Trader and then upgrade if you want to get the daily trade updates. All right. Have a good one, guys. Later.